You guys, so we need to have a very, very important conversation about covered calls. Now, I should have been talked about this one because this one is a income generating option trading strategy. That is when I made it a priority to invest in shares versus just trading the shares. Now, I've always been investing, but investing in 100 shares minimum in companies, and I'll explain exactly why. But what we're going to do really quickly is we are going to go directly into everything you need to understand the stock market, and we are going to read on exactly what cover calls is really quickly before I explain. So let's see. Let's go to page, what is 218, all right? Right here. Okay, so let's read really quickly what cover calls are. A covered call is a strategy where you sell a call option on a stock that you already own at least 100 shares of. The shares you own are the cover, making it a very safe strategy. Okay, now you heard that part, 100 shares, and you'll see how it ties into contracts and just when you're getting into call options or put options. The first thing, just as we just said, you need to have 100 shares, no matter what the stock is. Apple, Tesla, Sofi, American Airlines, Bank of America, it doesn't matter. You must have at least a minimum of 100 shares of any stock that you're looking to do a cover call on before you're able to participate in this strategy. And you know what? While we're here, let me say this, because I see a lot with a lot of new students who are new to trading options. They thought that you have to have at least 100 shares to option trade altogether, and you do not. When you are doing calls and puts, you are not required or obligated to have 100 shares of a company. But when you're doing covered calls, you are. A lot of you may need to have your accounts upgraded to a minimum of level 2 so that you will see other strategies outside of covered calls. Many platforms that have level 1, you may only have the ability to do covered calls. But for level 2, you should see calls, puts, and other strategies that you can participate in. So take the time to look at what level your account is on, because that could be the reason why you are not able to trade just calls and puts and only covered calls. Let's get into the second part on how this thing works. So let's say I have 100 shares in Apple. If I have 100 shares in Apple and I want to participate in a cover call, I will be paid a premium for leasing out my shares. So the way that I put it in the book and kind of the way that it was taught to me was in the manner of leasing out a house. Okay, you are leasing out a house, and that house is your 100 shares that you have in that particular company, and you're leasing it out to a tenant. So that tenant pays you their deposit, right? When you sell a call option, you're being paid a premium. You know how we pay a premium as retail investors that's getting into calls and puts? We pay a premium to enter into that option, right? But when you are selling a covered call, you are being paid the premium. So if I'm just saying I'm using Robinhood, I am paid that premium on the 100 shares that I'm renting out, and that money is automatically available to me. So I've just been paid to lease out my shares to someone else to lease or buy. We'll get into that part. Okay. So you're being paid to literally have these shares and to lease them out on the stock market. Okay. To participate in option trading. Now, here's the difference with cover calls and calls and puts when it comes to the strike prices. You will still select the strike price, but what's the main goal when we're trading calls and puts? If we're in a call, we need to see that thing going up so that we can profit. If we're in puts, we need to see that thing go down so that we are able to profit. But here's the kick with cover calls. When you select a strike, let's just say the stock, let's just say it's Apple, okay? And the current price of Apple is 209 at the time that I do my cover call. And let's just say I select a $215 strike price. I am basically saying, hey, I do not think Apple is going to hit or go past $215 by this expiration date. But if it does, you lose your shares. But don't be too scared about that, because guess what? Even though you lose those 100 shares, if it goes past the strike price that you selected, you will be paid the value of those shares out. Okay? So the strike price is different here with covered calls. You don't want it to skyrocket up. You want it to lay flat. You want it to kind of go up a little bit, maybe, but does not go past your strike price, whatever it may be. So if Apple is 209 and you select the 215 strike, you don't want it to go past that 215, okay, price. Because if it does, the individual who is leasing out your house, leasing out your shares, will then have the right to buy those shares at the original lower price that they had. Okay, so the only thing to that is if you have to turn over your 100 shares to that individual, you can do it again, get another 100 shares. But remember, you probably bought your 100 shares when Apple was like $150. But even pushed up past that strike price of, let's just say, 215, now you will have to buy another 100 shares for a much higher price than you may have already did it. But the thing I love about it, even though that is the case, is that not only was I paid a premium when I got into the cover call, I was also paid the value of those shares when I had to turn them over. Okay. So how I put it in the book was just basically saying you're renting out a house, which is your shares, to a tenant who is the investor that is renting out your car. And if it goes past the strike price, you are obligated to sell that house to them, which is your 100 shares. So even though I say you're not having to really focus on technicals and things like that, you don't have to really just focus on it heavily, but you do still want to, because you want to be sure that you selecting a strike price as well as expiration dates that can, keep it and say, okay, I don't think it's going to go past this price in this time frame, so I have a good chance of keeping my shares. And that leads to the next part. You were paid a premium to lease out those 100 shares to somebody. And the stock is 209 and you had a 215 strike price, and the price does not get up there. Let's just say it moves up maybe to 210 by the time that expiration comes around. You get to keep your 100 shares alongside the premium that you were paid, and that entire option expires worthless. So therefore, you got a premium, you got your 100 shares to do this shit all the way over again. That is the best part about it. Now, even though you are able to be paid, if you have to give up those 100 shares, but the best thing is being able to keep those 100 shares at the original price that you may have bought them for, and able to lease them all out again. It has been, I want to say, just last month, that was the third time that I have actually had to turn over my 100 shares for leasing it out on a covered call. Okay, third time. But hey, it happens. It's cool. But I do want to get my shares back. But the good thing about this, with Sofi, I'm currently up, I think, like 422 shares in SoFi. I've been investing in SoFi when it was a couple of dollars. I want to keep my shares because I got in SoFi when it was $6, $7. I got some at $12. SoFi is in its 20s now. So imagine me having to rebuy another 100 shares of that. I'm going to be paying $2,000 just to get 100 more shares in that stock. So with something like that, that is one of the reasons why keeping those 100 shares is a big thing. Okay, so you definitely want to plan out your covered calls accordingly so that it's more effective for you as the retail investor. But the very last part is, if you have more than 100 shares, let's say you have 200 shares, let's say you have 1,000 shares, the same way you're able to get multiple contracts and like calls and puts, you're able to do multiple contracts and covered calls as well. The thing is, though, you need to have enough shares that match it. So if one contract equals 100 shares and you want to do two contracts, you're going to need 200 shares in that particular company to do two contracts. You got 1,000 shares, okay? You're able to do upward of 10 contracts on your cover call. That's you collecting more money, more premium to pretty much you're leasing out all of your shares. But me personally, I don't do that. The max that I do, I only have 200 shares in about four different stocks, okay? But I never lease out all of my shares on there, okay? Especially after my third time of losing I keep it modest. I keep it in half. If I got 400, I might do a max of two, especially if it's a stock like SoFi that I was pretty much racking up on when it was a couple of dollars and making its way up, okay? So Covered calls is a income generating strategy that you can use, and I highly recommend that you fully get an understanding of. I hope this video gives you that understanding, but of course, it's going to cost you some change. Okay, you want to get 100 shares in Apple right now? Unfortunately, you are going to be looking at about $20,000. Okay, maybe Sofi, if you want to get 100 shares, you're going to be looking at about $2,000 or a little bit less. So, this is the thing that I want to say before we end this video. Something I tell my students: don't just go looking for stocks that are just hella cheap and say, I want to get 100 shares of. Still plan your investments wisely and not just pushing out money because a stock is $1 or $2. If it's $2, you can get 100 of those shares for $200. Now, if it's something worth doing or it has some sort of potential to push up, hey, go for it. Read their fundamentals, check out their chart, see if this company is still worth it. You still want to focus on quality stocks that you are buying your shares for. So you're not just pushing out money just to be able to participate in covered calls. You can do it. You absolutely can do it. But me personally, I think it's just the fact that I'm heavy on planning when it comes to investing and holding shares. The same way I am with option trading. You want to invest it wisely. But if this is something that you want to do to kind of test the waters, like find a cheap stock that maybe $1.52, $3, and you got two, three, $400 to spare, then hey, I'll say go for it. Do you? But just be sure that you continue to plan things out before you just dish out your money. All right. So I hope this helped. I hope this is something that you guys look into and use it as an income generating strategy for you and a way to build up your account, because it will be a lot easier for people who are just still stuck on this option trading games, as far as calls and puts, straddles, strangles, and a shit ton of other strategies that there are. Is highly understandable. So covered calls just might be the way to go. Now I'm going to get out of here, and if you guys want to grab the book, you guys can find it down below in my description, or wherever you may be watching this video, you can quickly find the link. I have covered calls in here: calls, puts, straddles, strangles, iron condors, all of the other strategies that there are inside the book for you to be able to check out. And with that, I will see you guys in the next video.